OD Jacob here. Today we're looking at ARRY Technologies in the electrical equipment industry. 1.6 billion market cap on 2.0 billion enterprise value. Current P looks fairly cheap, and operating margin kind of all over the place. Gross margin is kind of all over the place as well. Looks like on a good year you're looking at mid to low 20s gross margin, and then low teens operating margin with low double digit return on invested capital. And growth has been very impressive. I mean, let's see how long. Okay, incorporated in 1987, and their growth has been from 291 million in revenue in 2018 to 1.6 billion in 2023. It looks like there was an acquisition in 2022. Let's see whether that's the case. Okay, huge, pretty big net acquisition here. A little bit reinvestment back into themselves, and pretty positive free cash flow. Very positive news. Income statement shows that okay, gross profit pretty consistent from a differentiation of cost of goods sold and revenue. Sales and general admin growing as it should. Not really an R&D type company. Okay, shares increased quite a bit actually. Balance sheet has 249 million cash on hand with 21 million short-term debt. That's not a concern. 661 million long-term debt. That 660 million long-term debt is, I mean, even if you just do 2 years of free cash flow, you're still looking at about four times their 2 year average free cash flow. So it is a good amount, but we'll see. I mean, it's still, this acquisition is still new. It seems to be doing well, increasing both top and bottom line. But you have to keep in mind that you're just not looking at a long history here. And so, although it looks good now, we'll see whether that's just the market we're in or what, whether the demand stays up for that. But from now, it looks like a pretty solid acquisition. And yeah, I mean, let's figure out what we think it's worth. So growth. I mean, if they can keep producing this 100 million plus in free cash flow, that's a pretty good number. So let's say probably 5%, and I mean a pretty decent return on invested capital, pretty decent margins. I mean, gross margin isn't super impressive, but plus 10% on operating margin is definitely a number to brag about type thing. So share change, 1.6 billion, about 16 million would be 1%. Yeah, stock-based compensation is pretty much about that. So we'll say they increased shares 1%. And yeah, I mean, the rest of their free cash flow and acquisitions and everything, they're really just trying to get these type of margins with this type of revenue growth. And yeah, it just has to fall less than half. I mean, it's, again, sounds like a lot, but pretty decent company. Doesn't look like there's a whole lot of history. So I would like to see, I am more comfortable dealing with projecting with longer history lines, but still looks like a pretty decent company from what I'm seeing, and one that I'd want to own just at the right price. And here, um, it's about double what I'd want to own it at, based on my initial assumptions. So I'll probably do more research when it drops a bit more. But hopefully you enjoy the video and have a great rest of your day. Thank you.